In this video, we are going to take a look at how the market makers distort price in certain areas in order to employ reverse psychology maneuvers in most retail traders of the market. These market makers are individuals who have enough capital to move the market a few pips in strategic areas that trigger certain behaviors in most traders. This has tremendous benefits for the market makers and many disadvantages for the retail traders who are unaware of how such manipulations occur. First, let's understand why a market maker would do such a thing. The market makers have enough capital so that the liquidity of the markets becomes an issue. They cannot simply buy or sell an extremely large position anywhere they want in the chart at the same time they go unnoticed. They need deep pools of liquidity to manage their large orders. The obvious path for the market makers to create these deep liquidity pools is by manipulating the orders of millions of retail traders in the market. By manipulating orders, I don't mean that market makers can change the orders of retail traders. That's impossible. I mean that they can tilt the market in strategic areas where they know there are a lot of stop orders from retail traders. There are probably too many retail traders that pay attention to price-breaking highs and lows, and they seem to use this idea to get in and out of the market. This is one of the most common types of trading because it is so obvious. Today, we are going to see a simple type of market manipulation, but there are many types, and they can get pretty complicated. The market makers can induce retail traders to think the market is going in one direction by purposefully breaking a strategic high or low. This induces masses of retail traders to hit the trigger. That by itself creates a deep liquidity pool because there are many orders being triggered in one market level. This is where the window of opportunity of the market makers gets open. Since they have enough capital to perform these sorts of manipulations, when they see the deep liquidity pool being formed by millions of retail traders, they simply take the opposite trade. Since their purchasing power is greater than the retail traders, when the market makers execute their opposite order, the market starts to go in the opposite direction. By that time, retail traders start to get desperate because their positions are entering in negative territory. Many of these retail traders get too desperate, so they also reverse their position. This is even better for the market makers, because when the retail traders reverse their positions, all they are doing is to push the market maker's position further into profitable territory. Let's see a real-time example of this in the Euro-Dollar 5-minute chart. If you observe the chart carefully, you will notice that in number 1 through number 5, price was stair-stepping down, creating lower highs and lower lows. From number 6 to number 7, price fails to create a lower low, and from number 7 on, price starts to create higher highs and higher lows. This might trigger the attention of retail traders that could be thinking the market is going to rise. This notion is solidified after candle number 8, which seems to be a clear indication that price has a lot of momentum sustaining it to go high. However, what most retail traders don't know is that sometimes a candle like this is purposefully created by market makers to induce this pattern of thinking. The very next thing retail traders think is to place a buy stop order at the high number 2. However, take a look at what happens in candle 9. Price pierces the high number 2 and it closes below it in a low volatility candle. This is exactly where the manipulation took place. In the tail above the line from high number 2, which is where a lot of buy orders from retail traders were sitting. Since there were many orders at that level, market makers created a deep liquidity pool by purposefully driving the market beyond the high in number 2. They do that by simply buying large orders. When the retail traders' buy orders are triggered, the market makers begin to sell even more than what they bought in the attempt to bring the market down. When retail traders see candle 9 closed, they begin to feel a little desperate because the market didn't break the high number 2 in the way they expected, and their buy positions are in losing territory. In candle 10, you can see the first batch of retail traders giving up on their position, which drives the market even lower. Meanwhile, the market makers are already in profitable territory with a ridiculously large sell order. This is the time where the rest of retail traders begin to understand that this market is not going to rise, so they start selling to recover from their losses. Once again, this helps to drive the market maker's position even further into profitable territory. Let's jump forward a few minutes to see how the market developed. Sure enough, the market makers were successful in their manipulative maneuver and brought the market down by using the reverse psychology tricks that steer the retail traders in the market. This is how one of the manipulations occur in the market. We can clearly see that retail traders can make money here and there, but they are ultimately confused about what's going on, and they are not really understanding what is going to happen in advance. They are simply reacting. In the fractal flow strategy, we have a few ways of taking advantage of these manipulative maneuvers without needing to understand the full mechanism behind them. We can do that by analyzing the discrepancy between raw price action and the driving momentum of price within the layer of fractal analysis. If you have interest in learning how to trade using the fractal flow strategy, check out our strategy store in the video description. I hope you enjoyed the video and hopefully you learned something new and useful. Don't forget to support our channel by subscribing, leaving your like and comment below the video. Thank you for watching.